James Stock is joining us now. He is a professor of economics at Harvard. He was also the author of the lead paper presented here, an analysis of the Fed's policy tools and how they worked during the Great Recession. And we thank you for joining us. Basically, you found that they worked, but maybe not as badly as the markets thought, not as well as the Fed hoped.
Well, I think these new tools, which encompass forward guidance, long-term asset purchases, maturity extension programs, there's evidence they did have effect on changing the slope of the yield curve and reducing long-term rates, and those also had an effect on economic outcomes. Our estimate is that was worth about a percentage point on the Fed funds rate, so that this combination, this new suite of tools, gave us the equivalent of about an additional percentage point on the funds rate in terms of the effect on the economy.
Well, to shorten all the work you did down, there were a number of different effects, but one of the main conclusions you found is that if they had done them sooner, they might have had more impact. So you're suggesting that the Fed, when there's a need next time, when they hit the zero lower bound, come in with things like the balance sheet and forward guidance sooner. You call it stronger sooner.
Yes. So at the time, these were new tools. The Fed was really not sure how they would operate. There were concerns about whether they would set up a big inflationary spiral, which they did not. I think we know a lot more about them now than at the time. So what that suggests is that if we get hit by a big shock or even by a moderate shock, we can use these, or the Fed can use these tools now with a little bit more confidence. There are still built-in constraints. That's really important to understand. The Fed can't expand its balance sheet forever. There are questions about how effective these tools are in normal times in asset markets. But I think there is room for some of these stronger, sooner policies if we are to be facing a contraction.
You had some pushback in the discussion section by John Taylor, for one, who pointed out that a lot of what happened was an announcement effect. The Fed came out and said, we'll do asset purchases, and then you saw a reaction in the markets. But over time, that reaction reversed. How do you account for that?
Well, sure. These announcement effects are going to reverse. And both the long-term asset purchases, the LSAPs, there's going to be an equilibration in the marketplace. And also with forward guidance, you provide it over a certain horizon, but then as you progress down that horizon, the effects are going to be less. So these are not making permanent shifts. These are making shifts that are going to be long enough to have macroeconomic outcomes, but still measured in, let's say, a year or maybe a year and a half or half a year, not in terms of the very long run.
We know another recession will happen, and you talk to almost everybody on the Fed and they say interest rates are so low, we'll get to the zero lower bound.
Yeah.
Can you assure investors that based on your research, the central bank can do something about that?
Well, the central bank can do something about that. So, as I said, the LSAPs during the previous recession.
We call that QE, right?
Yeah, QE, well, also, and then the maturity extension program, that the combination of those and with forward guidance was perhaps these new tools were worth perhaps a percentage point on the Fed funds rate. Percentage point is something that gives us some effect on the unemployment rate, maybe half a percentage point to a percentage point effect on the unemployment rate, but it's not a panacea. So yes, the Fed has tools, but it's not a panacea, and the zero lower bound problem is a real problem.
Yeah, well, if we cut today, you'd get 250 basis points out of cutting rates.
Yeah.
You add another, that's 350. But you point out in your paper that under ordinary circumstances, the Fed would want to would have cut to negative 5%.
Yeah, that's absolutely true, and that was even during the much milder recessions in 1991 and in 2001 compared to the very severe recession, of course, we had most recently. So suppose we're facing another one of these mild recessions. We have tools. The Fed has tools, but not as many tools as it had going into those previous recessions.
Does that leave us, as Bill Dudley suggested in the conference, with having to turn to fiscal policy?
Well, certainly fiscal policy has to play a role, and that it played a modest role in those previous two recoveries, and arguably it would have to play a bigger role in a subsequent recession. We're in a bit of a challenge, and this is a paper on monetary policy, and it's a conference on monetary policy. Since you raised fiscal policy, we're in a bit of a challenging space right now, which is that we're already doing stimulative fiscal policy. So if we're going to do countercyclical on top of our pro-cyclical fiscal policy, we'd have to really take some steps that I think would be substantial and challenging. And that poses a whole host of political challenges.
Well, one last quick question. Jay Powell, in his comments, suggested that maybe the Fed's open to rate cuts depending on what happens with tariffs. Does it make it harder for them to do something like that in the short run because they have to worry about the long run?
I would say not necessarily. I mean, I would say not necessarily. So there's this theory, do you want to keep your powder dry? And I say no. I mean, if you see the economy weakening for some external factors, maybe tariffs, then it's appropriate for the Fed to try to keep the economy on this very stable, this really, this terrific place that we happen to be in right now. I think that the challenge at this conference is not about these very short-run things, but thinking about what's the longer-term strategy. Should it be something that the Fed does to consider allowing a reflation up to a higher target, for example?